Like you may have seen a few other creators doing as well, I wanted to create a video to go through my investing plan for 2025 because I find these videos super interesting and it helps to hold myself to account. I'll go through all my portfolios, give my thoughts on them and how they've performed in 2024, as well as what I plan to do with them this year in 2025. I've been through many different types of investing in my journey, from robo-advisor type platforms to picking managed funds to low-cost passive ETFs that I primarily invest in now. My experience with all of these has taught me a lot over the years, and I do really believe keeping it simple is the way to go, even though I still do not completely follow that philosophy myself. I consider my investing approach to be best summed up as keeping things pretty simple for long-term investing, but also taking some additional risks and using less mainstream options such as factor ETFs to keep things interesting for me. Before we begin, to be clear, this is my own personal investment plan that I'm sharing for entertainment purposes and never should be construed as investment recommendations or financial advice. Personal finance is personal, and what is suitable for me may not be suitable for you. Not to mention, I'm not a financial advisor or any type of guru, nor have I ever claimed to be. Remember, when investing, your capital is at risk and you may get back less than invested. Please always do your own research before making any investment decision. Okay, so I'm going to kick things off with my InvestEngine stocks and shares ISA that I've had since April 2023 when I transferred my ISA over from Hargreaves Lansdown. InvestEngine is an ETF only platform. I use it, unsurprisingly, for my main passive ETF portfolio. I have fiddled with the portfolio a few times this past year, arguably more than I probably should have, as it's not ideal to make too many changes and lose money to bid off a spread, but it is what it is. I don't hide anything. My current portfolio consists of 5 ETFs, XDEQ and GGRG, which are developed world quality factor ETFs, UC99, which is a USA quality factor ETF, ISP6, which is a US small cap ETF, and EMIM, which is an emerging markets ETF. So you can see it is primarily a quality factor portfolio. I did also, until recently, have a momentum factor ETF, which was the top performing ETF of the portfolio, as the winners really have just kept on winning this year. And regarding UC99, this was added to the portfolio in February, so that is why the returns for that one are a bit lower. Overall, this portfolio has slightly underperformed a simple global one fund portfolio in 2024 by a couple percentage points, and that is for a couple of reasons, but primarily because the quality factor has underperformed the market this year. As I always show in the videos that I mentioned factor investing, it's clearly not as simple as factor ETFs outperform every year, otherwise everyone would use them. And of course, past performance is no guarantee of future results. Just because factor ETFs have delivered market-beating returns previously does not mean they'll go on to in the future, but I'm happy to take that risk. The big drag on the portfolio really though has definitely been GGRG, as it does make up 35% of the overall portfolio, and due to the fact it is dividend weighted, it is underweight Nvidia, which pays a very small dividend. It's not hard to see why it has underperformed. I think pretty much any global fund that is underweight Nvidia will have underperformed this year. It has been a year all about momentum, and we've seen Nvidia and the Mag 7 in general just deliver incredible returns, hence why simple market cap weighted funds that are dominated by these Mag 7 stocks have done so well. It's worth remembering the market is a factor too. In terms of my plans for 2025, I don't really have anything set in my mind that I absolutely am going to change at the moment. I like the quality factor and I am willing to ride out some underperforming years, but really what I do want is a single global quality factor ETF rather than multiple quality factor ETFs. If a better option is launched or I see something else that I prefer, maybe I'll switch to that. As I've mentioned a lot of times, the quality factor ETFs we have at the moment tend to track sector neutral indexes, whereas the true outperformance long term has been seen by the non-sector neutral simple MSCI World Quality Index. I would love for an ETF to be launched that tracks that. The last thing to mention regarding my InvestEngine ISA is that as a result of the recent change that InvestEngine ISAs are now flexible, I actually have some allowance to use. Before this change, I had utilised all my allowance as I had contributed 20k total across all my various ISAs, but I'd forgotten that I had withdrawn about 4k from my InvestEngine ISA back at the start of the tax year. This was from my separate money market portfolio that I haven't shared, as it was just for a short-term goal. With the change to flexible in the last couple of weeks, the value of this withdrawal has basically been added to my allowance, as you can see here. So if we take away the 17.5k I've added to ISAs on other platforms, that means I have £4,293 ISA allowance to utilise. Now, I don't know if I'm going to manage to use all of this, but it does mean I will start regular contributions again to my InvestEngine ISA for the rest of this tax year. I think I'll aim for a minimum of about £400 per month, but we'll see how things go, and of course when the allowance resets in the new tax year in April, I'll keep up these regular contributions too. Okay, moving on to my InvestEngine SIPP now. This one is a lot more recent. Other than the £100 I put in way back in January when the SIPP first launched, all of the contributions here have been in the last month or so. I've decided to keep this one a lot more simple and perhaps more typical of what a lot of people do. It's just made up of two ETFs. The SPDR MSCI All Country World Index ETF with the ticker ACWI and the L&G Russell 2000 ETF with the ticker RTWP. I chose the ACWI ETF because it is now the cheapest all-world ETF from a total expense ratio perspective after a fee cut in August, with a TER of just 0.12% now. It may have a slightly worse bid-offer spread than VWRP, for example, but I personally see bid-offer spread as less important if you're planning to hold the shares for many years, as it is a one-off cost on transaction, whereas TER is an ongoing annual fee. And then RTWP I chose because it is my favourite accumulating US small cap ETF, as it actually tracks the Russell 2000 with a quality filter, so it should filter out some of the junk stocks that are in other Russell 2000 ETFs. I was torn between this ETF and ISP6, but I chose this one for my SIPP in the end simply because it is accumulating and therefore more hands-off, which is exactly what I wanted for my SIPP. As I'll not be able to access the money in this SIPP for just over 3 decades, I'm happy to keep this one super simple and leave it ticking away in the background. Therefore, I do not have any plans to make any changes in 2025 to this portfolio in terms of its composition. The only thing I could possibly see myself doing is removing the small cap component at some point if they do go on a very good run, but who knows. In terms of contributions, I do actually have just over 1k in tax relief pending that should be added to my SIPP by InvestEngine within 6 to 11 weeks of my contributions. So that'll be good to invest once received. And then I've also set up a regular savings plan of £100 per month going into the SIPP. This is deliberately set at a reasonably low level because I want to keep consistent contributions, but not overly commit myself as my income can fluctuate month to month. I may make further manual top-ups depending on my income situation. As I've explained in a couple previous videos, the great thing about SIPP contributions is they are highly tax efficient in that you get tax relief with basic rate added by your provider, and then if applicable, higher and additional rate claimed back via self-assessment. Of course, as it is a pension, the big downside is the access age, which is why I find it best to use both a SIPP and an ISA to give myself that flexibility. This is not my only pension, as I do have a workplace pension as well, which is a DB scheme, so there's no actual pot of money invested and therefore nothing to show. I just wanted to state this quickly because I know a lot of people might be wondering why I prioritise my ISA over my SIPP, and that's simply because my SIPP is not my only pension. And then lastly, I'll now switch over to my ISA held on Trading 212. I've been using Trading 212 for about 2 years now, but the ISA was only started this tax year. Previously, you could only contribute to one stocks and shares ISA, but this has now changed and I use both InvestEngine and Trading 212 because they allow me to access different types of investments and I like to keep them separate. Trading 212 allows you to invest into individual stocks, investment trusts and ETFs, whereas, as I've mentioned, InvestEngine is ETFs only. Trading 212's extra choice is both a pro and a con in my opinion, as it is nice to be able to access so many different things, but it does also lead to there being constant temptations, hence my reason for using both platforms and keeping portfolios separate. If you want to get started on Trading 212, you can get yourself a free fractional share worth up to £100 if you sign up via the link in the description, or if you've recently got the app, you can use the promo code TOM within 10 days of opening your account to claim your free fractional shares. This is an affiliate link and code, so for full transparency, I do get something too if you do use it. Thank you again to all those who have used it. Looking at my Trading 212 portfolio, the return on the chart here may look underwhelming, but that is because it just shows the profit loss of current open positions, not total return. According to my money weighted rate of return that I calculated myself using Excel, I do think I have slightly outperformed a global tracker since April at a rate of return of 19%, but I'm not entirely sure because I haven't simulated what the same deposits into a global tracker would have done. Until recently, I did have quite a few UK stocks that I'd picked myself, and these were mostly successful with some decent profits taken, apart from YouGov, which was a bit of a disaster. I've now in the last few months simplified the portfolio to just consist of primarily an investment trust, JGGI, a US small cap value ETF, USSC, and one last individual stock, Bloomsbury Publishing. My reason for having JGGI as the largest position is that whilst it is an actively managed investment trust, it does have a great track record and I really do like the strategy they employ. Of course, past performance does not guarantee future results and there are always risks of active funds underperforming passive options, hence why I have my ETF portfolio as well. I'm happy to take the risk with JGGI because, as I said, I like the strategy and also its unique way of aiming to provide both growth and income. it does mean I get some nice dividend payments that help satisfy that irrational dividend itch that investors often have. I say irrational because I know that I personally shouldn't care where returns come from, be that capital growth or dividends, as at my accumulation stage, total return is all that matters. USSC is in the portfolio because it is the only UKITS small cap value ETF available. It does unfortunately trade in USD, so there is an FX fee to pay, but I am happy to pay that to get some small cap value exposure, which could potentially do well with further rate cuts. Lastly, I've held on to Bloomsbury because the company has consistently beat expectations, and they have a great portfolio of authors that they publish for, particularly Sarah J. Maas, that has driven a lot of the growth that Bloomsbury has experienced. As it is an individual stock though, there are additional risks associated with it, and I've never claimed to be a good stock picker. That is why it is quite a small part of the overall portfolio. My plans going forward regarding contributions are to, from the start of the new tax year, to split contributions to my InvestEngine and Trading 212 ISAs when my ISA allowance resets. In the meantime, I'm just going to leave this portfolio as it is, and I do not have any plans to make any further sales. I may look to add a passive ETF to the portfolio as well in the second half of the year just to counteract the large weighting I have to an actively managed investment trust, but I'm undecided. I do like to allow myself about 10 to 20% of this portfolio for stock picking as well, just because I do enjoy it, but also like to keep the risks minimized. So that is all my portfolios and what I plan to do with them for 2025. As I say, personal finance is personal and everyone has their own investing strategies. I'm sure there's plenty that people disagree with here. The one portfolio that has been liquidated this year, which I haven't really shared on this channel, is my lifetime ISA. That had about 20k in it, and as it was for a short-term goal, my house deposit, it was fully invested in a very low risk, short-term money market fund. However, as I have bought my first home now, I've used that money and the portfolio no longer exists. So whilst that part of my overall investment plan no longer exists, I would say it is for a good reason. As it is the new year, I thought I'd finish on some investing themed New Year resolutions. I don't think having any sort of goal regarding hitting a certain portfolio milestone is worthwhile because it is completely out of my control how the markets perform. There's no point me aiming to hit 60k invested, for example, as for all I know there could be a big stock market crash around the corner. Instead, as a long-term investor, my New Year resolution is to keep up consistent resolutions and try not to be too much of a tinkerer with the portfolios and keep working towards my general goal of keeping things simple but interesting enough to keep me engaged. After all, I invest both to secure my financial future, but also it is a hobby for me. If you don't enjoy investing, it probably makes more sense to keep things super simple. These goals and resolutions regarding contributions and not being too much of a tinkerer are much better as achieving them are within my control. That is it for this video. I hope you found it interesting. If you did, please consider leaving a like and subscribing for more personal finance content. I hope to see you in the next one, and as always, thank you for watching.